Good evening to all. This special lecture series program for undergraduate students is organized by Kolkata Bidhannagar Society for Academic Advancement, coordinated by Azure Academic Services. Today's topic of discussion is redemption of preference shares. We are honored to have with us Mr. Sandip Bhattacharyya sir, Assistant Professor from Department of Commerce at THK Jain College, Kolkata, India. I would like to request Mr. Bhattacharya sir to lead today's discussion. Over to you, sir.
Thank you, sir. So, greetings to everyone. So, I want to start my extending deepest appreciation to Professor Prema Lama sir, Honorable Secretary of Kolkata Bidhannagar Society of Academic Advancement, West Bengal, India, for graciously providing me with this opportunity to address you today. I would also like to thank entire organizing team for their exceptional work in crafting of this enriching session aimed to add benefit of the students throughout pan-India level. So, with your kind permission, I would like to begin our discussion on our today's topic, that is redemption of preference share. So, I am sharing my screen and then we will discuss. So, I hope my screen is shared to you.
Yes, sir, it's perfectly visible.
Okay. So, now before I start, the slide you have already been presented, that is the redemption of preference shares. So now, what is redemption of preference share? So as in my slide, it has already been mentioned. So that redemption of preference share means that is the returning of preference share capital to the preference shareholders, either at a fixed date or after a certain point of time. That is, what does it exactly mean? That is, the redemption of pref share or the redemption of preference share. In short, it is redemption of pref share. That is, in redemption of pref share, it is an important concept in corporate accounting that involves that repurchasing of stock or repurchasing of preference shares issued by a company. So the preference share are basically a type of security, stocks that may provide certain benefits over the common of the equity shares. So that what does it exactly mean? That means that is a differentiate. That means that is a difference that makes a difference in between equity and preference share with a fixed amount of dividend. So that we can say that redemption of preference share is a process, or the redemption of preference share is a procedure of buying back of these securities to the shareholder. In my slide, you just see that is the redemption of preference share, that is company must purchase, or better you can say that company must repurchase this preference share during the lifetime of the company or in a certain condition. As you know very well that as per the Companies Act 2013, it is clearly mentioned that when we are supposed to proceed with the redemption of preference share, that it will be redeemed on a certain after a certain point of time. And what is the specific time? It has already been mentioned in the red herring prospectus of the company when it was issued. So that you can see, if we clarify the above statement, that is the redemption of preference shares by a company is not taken as a reducing of the authorized capital and such provision of the Act regarding the reduction of capital and not required the complied with. So shares are already issued or may be converted or may not be converted to the other types of preference share. So that as per the Companies Act 2013, it is clearly mentioned that in a simple way, that is on the time of the redemption, it can be redeemed after a certain point of time. It can be redeemed after a specific point of time. So that redemption of preference share, in short, in summary, that is the company should get back to its preference share from the existing preference shareholder after a certain point of time on the given price. Now, the what price it will be redeemed, that we will proceed in my later on. So that it is a very simple and a very easiest concept that you must appreciate, that the redemption of preference share means that is the preference share will be get back by the company or the repurchasing of share from the preference or the existing preference shareholders. Now coming to our next slide, that what are the important provisions regarding the redemption of preference shares which are given under the Companies Act. Now if you go through, that is the company's articles of association, that is it must be authorized by the company's articles of association, so that if articles of association permit, then it can be proceed, but otherwise it cannot be proceed. You know very well, my dear students, that the redemption of preference shares, practically it has clearly mentioned in the prospectus as well as the articles of association. So the first and foremost, that is company must authorize by his articles of association. Second is, as you can see, no such share shall be redeemed unless and until they are fully paid up. So that what does it mean? It means that if your share is a partly paid up shares, it cannot be redeemed. For example, I am just giving you one very simple example. Suppose Mr. X or X Limited, suppose X Limited issued 10,000 preference shares at the rate of rupees 100 each before 5 years. What I am saying, X Limited issued 10,000 preference shares at the rate of rupees 100 each. Suppose the issue price or face value is rupees 100 before 5 years. Now the thing is that after 5 years or the in between 5 years, the fully paid up share only 9,000. What does it mean? That is after 5 years or that in between these 5 years, only 9,000 shares are fully paid up. So that how can you redeem 10,000 shares? But you must say, sir, it has already been mentioned in the articles of association, so that you must have to redeem after 5 years. Okay, that's good, that's fine. I am all agree with you. But the thing is that, my dear students, that the redemption can be done only fully paid preference shares. So suppose if 1,000 preference shareholder, that is out of 10,000, 9,000 are fully paid. But if 1,000 preference shareholder, their preference share up to paid up capital is rupees 80, that is calls in area rupees 20, that is unpaid capital or called up capital. Only the called up capital is rupees 80, that is 80, that is 1,000 preference shareholders already paid rupees 80 and 20 is remain unpaid. So my dear students, you must appreciate the Companies Act, that how can you redeem this partly paid preference share unless and until they are supposed to fully paid. So there is a provision. There is a provision. As you can see, my point number 2, that the second line or third line, the partly share cannot be redeemed. Third line is the if these are the partly paid, then you must have to make the final call. And if this call is to be fruitful, that means after making of this final call, if it is a fully paid preference share, then the redemption can be carried out. So the thing is that if you are supposed to redeem your preference share, this preference share must have to fully paid, not the partly paid. If it is a partly paid, then first you must have to fully paid, that is the converted to the fully paid preference share, and then it will be, then the redemption will be carried out. Now I come to the my third point, that is such share can be redeemed out of profit of the company, that is the accumulated, as well as the out of proceeds of the fresh issue for the purpose of redemption. Now my dear students, this is very important one. This is very important one. And the entire thing is to be stand out on this point number 3, that is when I am calling up the preferential, or that is the redemption of preferential, it is either out of profit or out of the fresh issue proceedings by the company. Now what does this inferences, what does it implication, you will see in my later on slide. But for the time being, you must have to understand, when you are supposed to redeem the preference shares after 5 years, 10 years, what may be the stipulated time mentioned at the time of the issue of the preference shares. Your company must have to in a liquidity position flexibility. If you are in a liquidity crisis, if you are in a liquidity crunch, so that how can you redeem your preference share? And if you are not supposed to redeem your preference share, then the Companies Act will be violated. So that entire violation will be done. So that it must not be done. Preference share, if the preference share is redeemed, first of all, it is out of profit. Second is the, if you are not having the sufficient amount of fund in your reserve, that is the out of the fresh issue. What is the entire process? We will see, because we will start some and the various type of the clause and provision. We will see in my later on. But for the time being, you must have to read, that is the such share can be redeemed out of profit of the company as well as the out of proceeds of the fresh issue. Then, if the preference share redeemed at a premium, then such premium must be provided either out of the profits of the company or the securities premium account. Now the thing is that if you are supposed to issue preference share at a discount, at a premium, at a face value, whatever it may be, but the thing is that if you are supposed to redeem your preference share, it can be either in a premium value or in a face value. If it is a premium value, so the such premium, either it will be out of profit, that is the accumulated reserve. What will be the accumulated reserve, we will see in the later on. But the first is the, if you redeem preference share at a premium, then such premium must be provided, that is the out of profit of the company or the out of the carry out of securities premium account. If the company is supposed to have a securities premium account, then it must be carried out. And the capital redemption reserve can be utilized for the purpose of fully paid bonus to equity shareholder. So that this is the main 5 things that the very important, or the various type of provision under the redemption of preference share under the Companies Act. So I am moving to my next one. So what are the different efficacy of the redemption of pref shares? What are the different emergence of the redemption of pref share, or what are the different such issue of the preference shares? So that as you can see in my slide, that this either there is a capital management, either there is a improving of financial flexibility, that is the enhancing of shareholder value and the market perception and impact on the financial statement. I just explain it one by one. So that after the redemption process, or that on the timing of the redemption process, the company must have the sufficient amount of fund, that is company must have the sufficient amount of profit, that means company must have the sufficient amount of accumulated reserve fund to redeem these preference shares, so that as it has been stipulated by the company, so that there will be the relevant regulations and provision, so that we can say that if we are supposed to talking about, that is the capital management, if we are supposed to talking about the improving of flexibility, that means it allows the company, or better you can say it allows companies to manage their capital structure by reducing the number of outstanding preference share traded in the market. You know very well that is the capital structure means it is a consisting of own capital and debt capital. And this own capital such as consisting of the preference shares. So that it must be allows to company management to reduce their capital by way of reducing the number of outstanding preference shareholders. So that this can also help to optimize the balance in between equity and the impact of the various type of financial ratio, equity and various type of the financial health of the company. That means the performance as well as the efficiency level of the company. So that the capital management is various type of the implication in case of the redemption of preference. And if I am talking about the financial flexibility, that is, it is more effective in terms of business operation. It is more effective in terms of reinvestment. It is more effective in terms of various type of business productive and the operative facilities to pursue a new project. So that we can say it can also reduce the fixed amount of dividend obligations. It can also reduce the fixed obligation either in a terms of the preference dividend. So that if you are supposed to reduce your fixed obligation in terms of the preference dividend, not any other fixed obligation, so potentially it can free up your free cash flow fund. So that if I am supposed to enhancing the shareholder value and the market perception, so that it can also provide an opportunity to receive their invested capital fund. That means sometimes it may be either in a face value or it may be either in a premium. So that this can also be done by the realizing of the investment. That means if you are not having the sufficient amount of fund, that means if you are not having the sufficient amount of liquidity, so how can you say that the preference share will be redeemed in a smooth and flexible way? No, my dear students, it cannot be happen. So first you must have to check the liquidity position as well as the sufficient amount. If it is not, then you can move to the other sort of persuasion. And the various type of financial stability it can improvise, the better government and the better various type of practices. And what are the various type of impact of the financial statement? As you know very well, my dear students, that the financial statement it must be the organized form of the financial data that will be placed in front of the stakeholders of the company, so that on the basis of this financial data, the stakeholders of the company must have to know that what is the exact position of the company, whether they are supposed to invest, if there is enough potential investing in nature, or whether they can withdraw their investment from this company. All these things must be happen with this the financial statement, so that it may affect the various type of financial statement of the company. As you know very well, my dear students, that the financial statement example is balance sheet, statement of profit and loss account, that is your income statement, that is your cash flow statement, that is your ratio analysis, that is the comparative statement, and so on. So that it may affect the various type of balance sheet and the cash flow statement, statement of profit and loss account. That means the reporting of redemption must help in a provide to the accurate financial statement and the various type of investor of the stakeholders. So that if I am supposed to say that is the redemption, that means the managing or the understanding of the redemption of pref shares is effectively helps the company to maintain the liquidity, to maintain the shareholder maximization, to maintain the shareholders growth, to maintain the shareholder expectation. to maintain the various type of shareholder ratio, that means the shareholder equity value, and it must be comply with the various type of regulatory requirements, so that it is a strategic tool, it is a policy, it is a strategy making framework of the company that the company must use to optimize their capital structure. Company can enhance their financial flexibility. Company can comply with the regulatory requirements. So that these are the main efficacy of the redemption of pref shares. Next, I will move to, that is the what are the different methods of redemption of pref share. Just we have mentioned in our previous slide. That is when we are discussing, that is the what are the different provision given by the company. That is point number 3. That is the out of profit as well as the out of fresh issue of securities. So that we can say that preference shares are typically redeemed at the end of the fixed period of time. Preference shares are typically redeemed at the end of the stipulated time given by the company. That is, it was clearly mentioned in the prospectus at the time of the issue. So that after a certain point of time, what will be the decision by the company, that is, it will be out of profit or the out of fresh issue of stock. Now, if I explain out of profit, what does it mean? Out of profit means, better you can say that company can redeem preference share by using various type of accumulated profit or reserve. Now, what will be accumulated profit? We will see in our later slide. So that company can redeem or the repurchasing of preference share from the existing stock market preference share holders by using of the accumulated profit or the reserve. So that we can say that is ensuring that this does not affect, or that this does not affect the company's financial growth. This does not affect the financial stability. This cannot hamper the financial improvise of the company. So this does not affect company's financial movement. And if I am talking about company financial movement, being a student of finance, as you know, that it must be ensured that day-to-day working capital activity. So that out of profit means, that means that it can be redeemed by using of the various type of reserve and the accumulated profits. Second is the out of fresh issue of stocks. That means the preference shares can also be redeemed through the process of the new issue of the equity shares. Preference shares can also be redeemed through the process of the new issue of the different categories of preference share. My dear students, I am using the word different category, not in the same category. Sir, what does it mean? Suppose you have already issued, that means you means a company. Suppose the company has already issued 6% preference, 6% is a coupon rate. That means a 6% is a preference dividend. Now that at the time of the redemption, I am not having the sufficient amount of fund. So I need to issue. What type of security I need to issue? That means either in a form of equity or in a form of preference shares. Now, if I am supposed to issue preference share at the time of the redemption of the existing category, so first I need to mention that I am not used to issue 6% preference share because it has already been issued. Now it is at the time of the redemption. So that I am only supposed to issue, that is either a different category, that is either in below 6% or greater than 6% of preference dividend. That means I am not permitted to issue same category of preference share, that is the managing of liquidity or the managing of liquidity sources. So that means this can only be issued, that is the different category. So that out of profit and out of fresh issue of stock, if we clarify or that if we distinguish in between these two terms, out of profit means that is the out of profit or the out of accumulated reserve. That means the company having the sufficient amount of fund. That's it. But if I am supposed to derive, that is the out of fresh issue, That means the company doesn't have the sufficient amount of reserve. The company doesn't have the sufficient amount of profit so that it can be out of the fresh issue of stock. So that these are the main two methods of redemption of pref shares. I hope up to this it is clear to all of you. Next, I am moving that what are the different profits available. Just we have mentioned accumulated profit or reserve. At that time I was mentioned that I mentioned that the what are the different profits, or the what are the different profits available for the time of the redemption. Now these are the main charts. Now that this chart is not an exhaustive one. So that means what are the profits available? These are the chronological order. That means the general reserve, that is the common reserve fund. There is a statement of profit and loss account. There is a workman compensation fund. There is a dividend equalization fund, any other free reserve fund, any insurance fund. Now this list is not the exhaustive. But if when you are starting preference share redemption or the redemption of pref share, or the better you can say buyback, better you can say repurchasing, whatever you can say. So these are the free reserves available in the company balance sheet. These are the free reserve available in the company's financial statement where you can proceed of the preference share redemption. So that these are the chronological order, that is general reserve, profit and loss account, workman compensation, insurance, dividend equalization, as well as the various type of the other reserve fund. Now just come to the right hand side. That is the profits are not available for the redemption. That means these are the restricted one. But my dear students, if I am talking about the securities premium, I just have to mention that is to some extent. That is, if your preference share redeemed at a premium, you can utilize your securities premium money. As I already mentioned in my previous slide, that you may issue your preference share at the face value, at the discount, or at the premium. But if I am talking about the redemption case, that means if your preference share redemption at the premium value, that means this premium value you must have to utilize your securities premium if you are having in your balance sheet. So that these are the other restricted reserve, that is the share forfeiture fund, capital reserve fund, debenture redemption reserve, that is called DRR, as well as the capital redemption reserve fund, that is CRR. So that when I am talking about the Companies Act, that it permits the redemption out of profit, that I have already mentioned. That is otherwise in case of dividend, if it is an out of profit, that the transfer the equal amount to the CRR. Now how this amount transfer will be possible, we will see when you are supposed to do our sum on redemption of preference share, that in my later slide. So that means these are the profits available. You must have to transfer the entire value to the capital redemption reserve fund out of your total profits. So next I am moving. Now, what are the accounting treatment of redemption of pref shares? So first you need to create a capital redemption reserve at the time of the redemption. So the second is that you must have to pass the journal entries and any legal or financial implication, that is your reduced balance sheet. That's it. If you have been given the balance sheet, just you need to form the reduced balance sheet after passing of the redemption of pref shares. So first is the capital redemption reserve. So that a company might have to require to create a capital redemption reserve typically when I am saying that it was transferred from the general reserve, it was transferred from the any other free reserve, it was transferred from the any other reserve that which is not restricted in a balance sheet of the company. That means which must ensure that the company financial strength will not be compromised. I repeat this once again. That is, you must have to create the capital redemption reserve. In short abbreviation, it is called CRR, as it has already mentioned in my slide. CRR. So that means you must have to create CRR when you are supposed to proceed with the redemption purpose. But you must have to ensure that the financial strength of the company cannot be violated. This is the first one. Second is the journal entry. There are different journal entries. There are different journal entries as per the Companies Act or the company's regulation which you need to pass. How this journal entry will be processed, we will see in our later slide. And the second is the legal and financial implication. So that there are some legal compliance that must have to redemption process which comply with the legal requirements to avoid any penalties and maintain the corporate governance. So that you can say that redemption may affect the company balance sheet. You can say that redemption may affect the company's financial statement, yes, but to some extent. If you are redeem your preference share, obviously this preference share may be strike off from your balance sheet. And after that, you must have to prepare a reduced balance sheet. So that these are the various type of financial implications. Next, we will move to the what are the different accounting entries of redemption. Now I am moving to some. Now, before I moving to some, these are the entire background or theoretical aspects of redemption of pref shares. I hope some of the aspects you just have to mention, that is the redemption of pref share, that means out of profit as well as the out of fresh issue of stock, just to keep in your mind. Either it is a out of profit or the accumulated profit or reserve, or it is a out of fresh issue of shares. Now you just see that accounting entries of redemption. So just you see that these are the journal entries. Just you have to mention that is the what are the accounting treatment just in my previous slides. That means the creation of CRR, that is the capital redemption reserve. That is the creation of journal entry, that is the journal entry you must have to pass. And the thing is that is the various type of legal compliances and the financial implications. So that these are the journal entries. So that when you are supposed to redeem, that means your capital account must be debited. So the serial entry number 1 or the journal entry number 1, that is called the due entry. That is called due entry. Due entry means that is the preference share capital account debit, premium on preference share capital account debit if the premium on redemption will be happen at the time of the redemption to preference share holders account. Now that as you see, that is preference share capital account debit, it must be debit with the face value. Suppose your face value is rupees 100, just taking an example. Suppose your face value is rupees 100, and that after 5 years or 10 years or the what will be the stipulated time that you must have to redeem that is a 10% of the premium value. So that what we will do, that is 100 is your face value, premium is 10% on face value, that is rupees 10. So the total 100 plus 10, that is 110 is your redemption. So that you must have to debit, that is preferential capital account debit, that is the face value, premium on preferential capital, that is rupees 10, that means preferential capital account debit 100. If it is a face value, then it will be 100. If it is a premium value, then the premium must be entered separately. That means the premium on preferential capital account debit to preferential holders account. So that this is called due entry. Second is the payment entry, that is journal entry number 2. That is preferential holders account debit to bank account. So just if you go through journal entry number 1 and journal entry number 2, that you can see preferential holders, once it has been credited, preferential holders it is debited. That means it will be strike off. So ultimately what is the objective? Preferential capital account debit. If there is a premium, then premium on preferential capital account debit to bank account. So that if you combine journal entry number 1 and journal entry number 2, then it must be the preferential holders is to be strike off. So the first is the due entry, second is the payment entry. When we will do this sum, we will do exactly in the same format. This is the generalized format. Journal entry number 3, as you can see, bank account debit to share capital. Now, if you go through the issue of shares, then the obviously if you are supposed to enter the share capital, that means if you are supposed to issue a new category of shares, that means obviously your bank account will be debited. That means your bank account, that means the liquidity flows into your company. That means the liquidity inflows into your company, better you can see. So that the bank account debit, so what is the essence? That is the bank account debit to share capital. That means your company issuing new category of share. That means if you remember, you must appreciate, if you remember that the out of profit as well as the out of fresh issue of stock, this is the fresh issue of stock. I am telling this is the generalized format. I am telling that this is the generalized format. So that the bank account debit to share capital, so that that means if you are issuing new category of pref share, that is bank account debit to new category of pref share. New category means that means the preference dividend cannot be same, either it will be reduced or that it will be elevated. So that the bank account debit to share capital, it may be the ordinary share, that means the equity share, it may be the new category of preference share, whatever it may be. That means you do not have the sufficient amount of liquidity or fund, that means you are supposed to proceed your redemption out of the fresh issue. So that this is the bank account debit to share capital or the bank account debit to new category of the share capital. So journal entry number 1, 2, 3, I think this is clear. Next I come to journal entry number 4. You can see that is the investment account is credited. So why, sir? Because if you are having a non-current investment, if you are having a non-current investment as well as the current investment in your company or the whatever be the category investment in your company balance sheet. Now, if you are in a liquidity crisis or in a liquidity crunch, that means you must have to sell some sort of asset. Now, now you now you know very well that the investment is the one category of the asset of the company, and you must have to sell investment if it is done. So that the bank account debit, profit and loss account debit, if you sell, then the obvious it will be either in a loss or that either in a profit. If it is a loss, then the profit and loss is debited, and simultaneously if it is a profit, then the bank account debit to investment to statement of profit and loss account. So that what is my objective? My objective, to any way it can be redeemed, otherwise the Companies Act will be violated. If I doesn't have the sufficient working capital, if I doesn't have the liquidity, so that I must to do some exceptionals. So that the bank account debit, profit and loss account debit, if it is a loss category, to the investment account, to profit and loss account if it is a profit. Now, journal entry number 5, as you can see, that is premium on pref share capital. As you see in my journal entry number 1, that is premium on pref share capital account, premium on redemption. Now I am telling you that if your preference are redeemed at a premium, that means these are the two funds you can need to set aside to create a premium for preference share capital. I repeat this once again. That means if your preference share redeemed at a premium, I repeat, if your preference share redeemed at a premium, that means these two funds must have to be set aside to the redemption premium value. So that means you must have to fetch securities premium, you must have to fetch the amount from the general reserve to premium on pref share capital. So that means your premium value must have to be done with these two categories of reserve fund. And you must appreciate that the securities premium is debited, general reserve is debited. Both the reserves are debited. That means the amount is to be fetched off from this category of the reserve and the transfer to the premium on pref share capital. And the journal entry number 6, that is the creation of CRR, that is capital redemption reserve, that is the face value. That is the face value of the preference share capital. That means the free reserve account debit, as we have already stated, that the what are the free reserve, general reserve as well as the statement of PL. So that the general reserve account debit, statement of PL account debit to capital redemption reserve. So that this must have to be the face value, this must have to be the issue price of the preference shareholders. So these are the generalized format. This is not the entire list, because when you are supposed to do some, there will be some entire things this will be done. But these are the generalized format or the generalized journal entries of the redemption of pref share. I hope up to this it is clear to you. Now, this is a very simple illustration. We will do first very simple illustration, then we will move to the moderate, right? So now, as you can see, X company limited had issued 2 lakhs 6%. Now note this point. 2 lakhs means number of preferential outstanding is how much? Rupees 2 lakh. And 6% is the coupon rate, that is the preference dividend, that is the category of preference shares. 6% redeemable preference shares of rupees 100 each. I repeat this once again. X Limited issued 2 lakh 6% redeemable preference share at rupees 100 each. So that what is the existing preference share capital issued in the market as per the book value or face value? That is 2 lakh into 100. That is rupees 2 crore. That is rupees 2 crore preference shareholders has already issued in the market on the basis of the face value or the book value of the company. Okay. Under the terms of the issue of share, redemption was taken place on 1st April 2012. Okay. Now, a general reserve of rupees 1 crore 25 lakhs has already been built up out of the profits. So, a company has a general reserve, that is a free reserve category. As you know very well, general reserve. So that what are the free reserve list? That is general reserve, statement of PL, dividend equalization, any other free reserve, workman compensation, as well as the insurance fund, which is not restricted or that which is not mentioned in the restriction. So that our general reserve is rupees 1 crore 25 lakhs has already been built up out of the past profits. Okay. So for the purpose of redemption, 75,000 new 5%. Please underline this word, my dear students. Please underline this word. 5%. 5% pref shares of rupees 100 each were offered to public at a premium of rupees 50, payable fully on application. The new issue was fully subscribed and paid for. Thereupon, 6% redemption or 6% redeemable preference shares were redeemed. Make the journal entries to record the transaction. So the sum is very clear to all of us. That means the 2 lakh equity, a 2 lakh pref shares, which is a category of 6%. That is the 6% pref dividend at rupees 100. Okay. A general reserve has already been stated, that is the 1 crore 25 lakh shown in the balance sheet. That's very good. But the thing is that is the main clause of the sum. For the purpose of redemption, 75,000 new 5%, as I already mentioned in my previous slide. That is, you must have to issue new category of pref shares, not in an existing one. What is the existing one? 6%. So you must have to issue either the below 6% or the elevated of 6%. So that you cannot issue the exactly the same one, that is 6%. Your articles of association doesn't permit it. So that you must have to issue either the below 6% coupon rate or the above 6% coupon rate. Now, in this case, company issued below 6% coupon rate, that is the 5% pref shares of rupees 100 each offered to the public at a premium of rupees 50. That means the face value is 100 and the premium on face value it is rupees 50, that is the 50% premium, that is rupees 150. And the new share are fully subscribed. So that we now have the journal entries. I think the sum is clear, right? Now, as you can see, I have already done the solution. So first is the due entry. Just you remember the slide. Just you remember the generalized format of the journal entry, as I have already mentioned. Just remember, that is the due entry, payment entry, premium set aside, new issue, as well as the capital redemption. I repeat, you just have to memorize that is the generalized of the journal entry. First is the due entry, second is the payment entry, third is the new issue, fourth is the premium if they are in, and the fifth one is the journal entry. And the fifth one is the journal entry for the capital redemption reserve. So the journal entry number 1, that is serial entry number 1, that is a due entry, that is 6% preference share capital account debit. Now as you go through the sum, that is there was a 2 lakh preference shares at the rate of 100 each. 2 lakh preference shares at the rate of 100 each. So the 2 lakh into 100, that is rupees 2 crore. Now 6% preference share capital account debit to preference share holders account. Now your question might be, my dear students, you must appreciate, sir, what will be the premium? Sir, you have mentioned already, sir, preference share, that is the preference share capital account debit, premium on preference share capital account debit to preference shareholder. But in this case, there is only 6% redeemable preference share capital account debit to preference shareholder. Where will be the premium entry? So, my dear students, premium can only be happen if the preference share redeemed at a premium. In this case, preference share not redeemed at a premium, but the new category issued or the new category of preference share can be issued with the premium value. I repeat this once again. In this case, the existing share redeemed at a face value, not in a premium value. But when I am talking about the new category, that is the new category of pref share issued, that was only the premium one, that is the 50. So the first is the due entry, as you see the journal entry number 1. 6% preference share capital account debit. That is, if I am talking about 6% preference share capital account debit, so that means what? That means 2 lakh into rupees 100. That is 2 crore to preference share holders account. Second entry is the payment entry. That is the banking payment entry. That means preference share holders account debit to bank account. That is rupees 2 lakh. Now, first is the due entry, second is the payment entry. It was over. Now sort out the case number, that is the journal entry number 3 or the serial entry number 3. That means you have issued new category of pref share. That means the capital inflow in your business. That means your bank account should be an elevated one. That means your bank account is debited. So the bank account debit, how much? I have already made the calculation here. 75,000 into 150. Because why? Because you have issued 75,000 preference shares on 5% new category of pref share. And the total price is 150. 100 is your face value and 50 is your premium value. Okay, that's fine. So that the bank account is debit 75,000 into 150. That is 1 crore 12 lakh 50,000. To 5% pref share capital account, that is the face value. That is 75,000 into 100. That I have already mentioned the calculation here. That is the 75,000 into 100. That is 75 lakhs. And the securities premium that I have mentioned. That is the securities premium. That is rupees 50. That is the 75,000 into 50. That is the 37 lakh 50,000. That means the entire fund. That means the entire securities premium issued. So that the first is the due entry, second is the payment entry, third is the new issue of entry. So my dear students, now you can categorize. That what is the essence of this fresh issue. I have already mentioned there are 2 types of redemption. There is the 2 methods of redemption, better you can say. Out of profit or out of the accumulated profit. Second is the out of the fresh issue of stock or securities. So now this company doesn't have sufficient amount of liquidity. As the total bank amount is not being mentioned in the question, but this fund is not sufficient, or this amount is not sufficient to meet up the obligation at the time of the preference shares. So that the new category of pref share will be issued, or that the new category of securities will be issued. So the first entry is the due entry, second is the payment entry, and third is the new issue entry. Fourth is the creation of capital redemption reserve. Now your question may be, sir, general reserve account debit. Now general reserve is my one of the free reserve, and in question it has already mentioned it was 1 crore 25 lakhs. So that why this is 1 crore 25 lakhs, that is you have already mentioned that capital redemption reserve must have to be created the entire face value of the redemption. I repeat once again. Sir, you have already mentioned that the capital redemption reserve must have to be created the entire face value of the redemption. Now, in this case, that is the entire face value of the redemption is rupees 2 crore. So that why don't you pass the entry that is the general reserve of rupees 2 crore to the capital redemption reserve? So, my dear students, there is some one small calculations are there. General reserve is 1 crore 25 lakh that I am already having in the balance sheet. How can I accumulate it? That is fetching out rupees 2 crore from the general reserve fund. So there is a calculation. You just see in my slide. As you see, that is the note that I have already mentioned in the working note. This is the working note shown in the table form. That is how much amount transferred to capital redemption reserve. That is the face value of share redeem. How much the face value of share redeem? That is rupees 2 crore. What is the new issue of share? That is the face value of rupees 75 lakhs. So how much amount transferred to CRR? That is 1 crore 25 lakhs. And this 1 crore 25 lakh must have to be fetched out from the free reserve. But as you know, in this sum, no other free reserves are available. So that only the general reserves are there, so that we simply fetching out the amount from the general reserve category. So that these are the main theme or the main calculation, that is point number 4, that is in this sum. These are very simple sum, but this is the main theme that is in journal entry number 4. That is how much amount transferred to the capital redemption reserve. So that this is the formula, that is face value of the share redeem with the subtraction of the new proceeds or the proceeds from face issue or the new issue of share or the new share issued, whatever it may be. So that the rest or the substantial value transferred to the capital redemption reserve. So that this is a very simple sum on the redemption. We will proceed to the next one. I think it is clear. See illustration number 2. The balance sheet of Besto Limited or B Limited as on 31st of March 2012 disclosed are the following information. There is some authorized capital of 5% redeemable preference shares of rupees 10 each, that is 1,50,000. Ordinary shares of rupees 10 each, that is 5 lakh. Okay. These are the authorized capital. Fine. Now, this is the paid up capital. 5% redeemable preference share capital, 10 each fully paid, 1,10,000. Ordinary shares 10 each fully paid of rupees 3 lakh. Profit and loss amount is rupees 2 lakh. Okay, that's fine. So that we are only concerned with the paid up capital, not in authorized capital, because authorized capital, the company entire lifespan. Because we know the company has a perpetual succession. So that means authorized capital will be issued the entire lifespan of the company during the perpetual succession of the company. So that we are only concerned with the paid up value. That is the out of authorized capital, how much it will be paid up or the subscribed capital. That is the 5% redeemable preference shares of rupees 10 is, that is the face value, that is rupees 1,10,000. Ordinary shares 10 is, that is rupees 3 lakh, as well as the profit and loss amount, that is the free reserve available, is rupees 2 lakh. Okay, that's fine. Now, on 6th April 2012, the date is not an important here, right? So the somehow the date is mentioned, right? But the date is not an important one. The preference share were redeemed at a premium of rupees 4 per share. Now, what is the difference in case of first and second illustration? That is the preference share redeemed at rupees 4 per share. What is the face value? Sir, face value is rupees 10. That means the 40% premium. That means preference share are going to be redeemed at the 40% premium value. Okay, that's fine. The company couldn't trace. Now, please make it underline, my dear students. The company couldn't trace the 1,200 preference shares at the time of the redemption. So that when a company proceed with the redemption, then the 1,200 preference share cannot be traced anymore. And for 8th April 2012, the company issued bonus share, one fully paid ordinary share of every 5 share held. That's a different issue. You know very well that as the paid up capital, that is ordinary shares 10 each or fully paid of rupees 3 lakh. That means the how much the ordinary preference share capital, how much the ordinary equity share capital, 3 lakh divided by 10, that is 30,000. So every 5 equity share company will issue one bonus share. That's a different issue. Show the journal entries and the record of the transaction including cash, and show this account how it will be appeared in the balance sheet. So first we will make the journal entries with some necessary workings. So that at first you can see the 5% preference share capital 10 each of rupees 1,10,000. That means how much preference share? 11,000. That's fine. Ordinary shares 10 each of rupees 3 lakh. How much equity share? That is the ordinary share. 3 lakh by 10, that is 30,000. That's fine. And then we are having only the profit and loss account of rupees 2 lakh. That's fine. Now the preference shares are to be redeemed at rupees 4 per share, and the at the time of redemption the company couldn't face 1,200 preference share holders. Okay. So now this is the overall synopsis of this sum. Now we will move to solution. So that as you can see the journal entries, that is the 5% redeemable preference share capital account debit. Now I have already mentioned the calculation here. That is the 11,000. I just escape my screen and just you can see this one. This one I am just highlighting. That is the 11,000 into rupees 10. So that this 11,000, that means the total is total 1,10,000. That is the preference share capital into rupees 10. That is the 5% redeemable pref share capital. That is 1,10,000. Premium on preference share capital, I am just highlighting. That is the 40% premium value. That is the this one. That is 11,000 into rupees 4. That is 44,000. To preference shareholder account, that is 1,54,000. So just I need to enter screen. That is yes. So that it is 5% pref share capital account. 11,000 into rupees 10. That is 1,10,000. Now the premium on preference share capital account, if it is a premium value, that is the 11,000 into rupees 4, that is 44,000. To preference shareholder account, that is 1,54,000. So that this is the due entry. As you generalize the journal transaction, this is the due entry. Now the what is the payment entry? Now the payment entry is that is the preference shareholders account debit. Now please keep it underlined, that is 9,800 shares. You can see this 9,800 shares, how it will be, because at the time of redemption 1,200 preference share could not be traced. So that means you must have to subtract these 1,200 preference share out of your total preference shareholders. So just you see the calculation here, that is 11,000 minus 1,200, that is 9,200. 11,000 minus 1,200, that is 9,200. Sorry, that is 9,800. So that this 9,800 into rupees 14. So the second is the due first is the due entry, second is the payment entry, and the payment is 9,800 preference shares. So the 9,800 into rupees 14, that is 1,37,200. So the preference shareholders account debit to bank account, it is 1,37,200. So that I hope up to this it is clear to all of you. So first is the due entry, that is the 5% redeemable preference share capital, that is the face value. Second is the premium on redeemable preference share, that is the premium on preference share capital, 11,000 into 4 to preference shareholder account. And the second is the due entry, that is the payment entry, that is the 1,200 preference shareholder cannot be traced, so that the preference shareholder account debit to bank account, that is the 9,800 into rupees 14. Now the journal entry number 3, that is this premium value, how it will be set aside, that is profit and loss account debit. As you know very well that in sum you are having rupees 2 lakh in your profit and loss account. So profit and loss account debit to premium on preference share capital account is rupees 44,000. profit and loss account debit 11,000 shares into rupees 4. But your question may be said, 1200 preference share cannot be traceable. But you still need to set aside this premium. Yes, my dear students. In case of 1200 preference share cannot be traceable, you must amount separated from the free reserve. But when I am supposed to pass the bank entry, that is the payment entry, my dear students, it will be set aside. So that the profit and loss account debit 44,000 to premium on pref share capital. How this 44,000? You know that is the 11,000 preference share into rupees 4. And second is the capital redemption reserve creation. So that the statement of profit and loss account debit is 1,10,000 to capital redemption reserve. So this capital redemption reserve, as you can say, that means that the amount should be fetched from the general reserve or the statement of PL or any other free reserve. And the last two entries are the bonus to equity shareholders. As you know very well, that is the 1 share for every 5 share. So for 5 share, it will be 1. So that there will be 30,000 shares, so that it will be 60,000. So that it will be 60 plus 10, that is rupees 1 lakh. So that these are the main theme of the second sum. Now consider this illustration. Determine the amount of fresh issue of share from the following information of S Limited. Now in this case, how much total amount of fresh issue you need to calculate? Now what is the difference in this sum? Now the difference is, in our first two cases, how much share will be, or the how much fresh issue of share, it has already been mentioned. But in this case, how much share we need to issue for the fresh issue, or that you can say for the purpose of redemption, that is to be calculated. How it will be calculated? See, the question is, that is the redeemable preference shares of rupees 2 lakh. Premium on redemption is 10%. Divisible profits available is 60,000. Balance on general reserve is rupees 40,000. Securities premium is rupees 15,000. And fresh issue to be made at a discount of at the rate of 10%. Now the thing is that is you must have to redeem at the 10% of the premium value, that is 2 lakh plus 10%, that is 2,10,000. Divisible profits are available is 60,000. Balance on general reserve is 40,000. Securities premium is 15,000, and the fresh issue is that is the 10%. Now you just see the solution. That is face value of preference share redeem of rupees 2 lakh. Okay. Premium on redemption, how much? That is 10% premium, that is 2 lakh into 10%, that is rupees 20,000. Now this premium must have to be paid out of the free reserve amount. Now as you can see, that is how much divisible profits are available? 60,000. Balance on general reserve is how much available? 40,000. And the how much securities premium is 15,000. So securities premium, so that if you remember, the securities premium can be utilized to some extent. You can remember that is securities premium can be utilized to some extent. Now here 15,000 is in my securities premium. But what will be the redemption? The premium on redemption is 20,000. So in my balance sheet, just listen it very, very carefully. It is a very simple one. In my balance sheet, securities premium is 15,000. Okay. But premium on redemption is 20,000. So obviously there will be a deficit of 5,000, yes or no? So that's why I have written here, premium on redemption of pref share amounting to rupees 20,000 will be made out of securities premium money of rupees 15,000. But this amount cannot, this amount is not sufficient, because we need to set aside 20,000, but we are having only 15,000 in securities premium. So first, as per the chronological order, securities premium we must have to utilize, but the additional 5,000 we need to fetch out from the free reserve. So now, in my point number 4, that is profit available redemption of pref shares is how much? 60,000 plus 40,000 minus 5,000. So that means total divisible profit, as you can see in my sum, total divisible profit available is how much? 60,000. Balance on general reserve is available is how much? 40,000. So 60 plus 40, how much it will be? 1 lakh. But my dear students, is it 1 lakh available? No. Because what will be the deficit of 5,000 of securities premium? So this 5,000 must have to be adjusted with this free reserve. So the 60,000 plus 40,000 minus 5,000, that is 95,000. Now, how much amount, or that how much fresh issue of share? What is your question? My question will be determine the fresh issue or number of fresh issue of share, or the what is the proceedings of fresh issue. So what is the face value? Face value of preference share redeemed is rupees 2 lakh. So 2 lakh minus total divisible profit available for redemption, that is 95,000. So 2 lakh minus 95,000, how much it will be? 1,05,000. I repeat this once again. I repeat. Face value of preference share redeem is how much? Face value of preference share redeem is 2 lakh. But how much divisible profits are available? The divisible profits are available is 95,000. So that what will be the fresh issue of amount? That is fresh issue is 2 lakh minus 95, that is 1,05,000. But in your question, that the fresh issue must be at 10% of discount rate. So can I say that this 1,05,000 is my 90% value? So if it is a 90% value, then what will be the full amount of fresh issue capital? Then 1,05,000 into 100 divided by 90. Or you can do it in another way, that is 1,05,000 divided by the 90%. So that the entire fresh issue of capital is 1,16,670 approx. So that this is the sum, that is the fresh issue of equity shares. So we must have to categorize 3 categories, that is the out of profit as well as the out of fresh issue. Out of profit means that is the accumulated profit. Out of fresh issue means that is the you do not have the sufficient amount of fund. I hope up to this it is clear, my dear students. So now as you can see the entire sum, or the another type of important sum. The following books of XYZ Limited are as follows. Now this is a balance sheet. That is equity and liabilities. That is the share capital is rupees 6 lakh. That is the note number 1. And the share capital consists, you just see the downward, that is 1,300 preference share at the rate of 100 each. That is the footnote of this slide. You just see the footnote of this slide. That is the downward. That is the below mentioned one. You can see the entire share capital is rupees 6 lakh, and that there was a note number 1. And the what is the note number 1? That is 1,300 pref share at the rate of 100 each, and the 47,000 equity shares at the rate of 10 each. So the 13,000 pref share 100 each means 1,30,000, and 47,000 equity share at the rate of 10 each, that is 4,70,000. So 1,30,000 plus 4,70,000, it will be consist to be 6 lakh. Clear, my dear students? Next is the reserve and surplus, and the entire reserve and surplus consisting profit and loss account. You just see in my slide I have mentioned that is profit and loss, that is PL. That is statement of profit and loss account is 90,000. So that you are only having rupees 90,000. Okay. Second is the current liability. That is the trade payable or creditors is rupees 1,10,000. And the total is rupees 8 lakh. That is 6 lakh 90 plus 1 lakh 10. That is total capital and liability is rupees 8 lakh. Now they come to the asset side. That is the non-current asset. That is the fixed asset. That is under the fixed asset property, plant and equipment. That is the tangible asset. That is rupees 6 lakh. And you are having, that is the non-current investment is 30,000. So the total fixed asset, that is the non-current asset, is 6 lakh plus 30, that is 6 lakh 30,000. We are having the another category of asset, that is the current asset. There is the current asset. Under the current asset is rupees 1 lakh, and the cash and cash equivalent is to be given in a separate category, 70,000. So 6 lakh 30 plus 1 lakh plus 70, that is rupees 8 lakh. So that this is the entire form of the balance sheet. Now there are some additional information. What are they? It was decided to redeem pref shares at the rate of 10% premium. So that preference shares are to be redeemed at the rate of 10% premium. So that what is the total amount of preference share capital? That is 1,30,000. How the 1,30,000? 1,300 preference share consisting of rupees 100 each. That means 1,300 into 100, that is 1,30,000, and these preference shares are redeemed at the rate of 10% premium. Okay. So for this purpose of redemption, there are some decision by the company. What are they? Selling of an investment. You can see the balance sheet. There is a current investment. There is a non-current investment of rupees 30,000. So this 30,000 will be sold. That is rupees 24,000. That means there is a obviously 6,000 loss. To finance the part of redemption, subject to minimum bank balance is 26,000. Very, very important line, my dear students. You just see that cash and cash equivalent is how much? 70,000. So out of 70,000, it is a mandatory requirement of maintaining balance in your account. It is a mandatory balance requirement in your account, that is 26,000. So you cannot utilize 70,000. You just have to utilize 70,000 minus 26,000 as a residual part. It is a mandatory. It is a mandate of the requirements. And to issue minimum number of equity share 10 each at the rate of 10% premium to raise fund. So, my dear students, can you classify which category of sum it is? Whether it is out of profit or whether it is out of fresh issue. It must be out of fresh issue of stock, because you do not have sufficient amount of fund. You do not have the sufficient amount of liquidity to balance or to meet up the redemption. You must have to issue minimum number of equity shares. How many number of equity shares? That is not mentioned. That will be calculated. So I just need to synopsis this sum. Share capital 6 lakh. Reserve and surplus is 90,000. These are the only free reserves are available in my balance sheet. And the total current liability is 1,10,000. So 6 lakh 90 plus 1 lakh 10, the total asset, total liability is 1,10,000, 8 lakh. That is total capital and liability is rupees 8 lakh. Second is the asset. That means the fixed asset, there is a tangible one is 6 lakh and the non-current investment is 30,000. Current asset is rupees 1 lakh and the cash and cash equivalent is 70,000. That's fine. And in case of share capital, that is the two category of share. There is pref share as well as the equity share. How much category of the pref share? There is 1,300 preference share at the rate of 100 each is rupees 1,30,000, and the 47,000 equity share at the rate of 10 is, that is 4,70,000. And the some categories information are there. That means the redemption of pref share at the rate of 10% of the premium value. And for the purpose of the redemption, the sale of investment is 24,000. And to finance the part of redemption, the minimum bank balance should have to maintain. It is 26,000. And to finance the part of redemption, the company issue the fresh issue of share. How much the fresh issue of share? It doesn't mention. Rather than it has been said that is the face value of rupees 10 at the rate of 10% premium value. So now we will move to some solution. So first you can see 1,300 preference shares at the rate of rupees 100 each. So that these are some working notes. Actually, these are some working notes. You just see the first one, that is the left hand side, not to the right hand side. You just see the left hand side. These are some working notes. We will do the journal entry later on. So 1300 preference share at the rate of 100 each. That is 1,30,000. Premium on redemption, because as it has been mentioned in the question paper that the preference share redeemed at a 10% of premium, that is 13. That is the 1,30,000 into 10%, that is 13,000. So that how much the total preference share? That is 1,43,000. So that this is working note number 1. Now you see how much bank balance are available. Now you can see how much bank balance are available. So as you see that bank balance in my balance sheet, that is cash or cash equivalent. That is cash or cash equivalent is 70,000. But out of 70,000, it was mandated in the balance sheet that 26,000 is the minimum amount of requirement. So just I have mentioned that the bank balance is 70,000. Subtraction of the amount requirement, that is the mandate of the that is the mandate in my bank account, that is 26,000. So you need to utilize only 44,000. But there is some additional cash inflow. What is the additional cash inflow? If I am talking about selling of investment, what will be the journal entry? Bank account debit. If it is a loss, then statement of profit and loss account debit to investment. If it is a profit, bank account debit to investment to statement of profit and loss account. So bank account debit means how much? That means bank account debit with rupees 24,000. Why 24,000? Because my non-current investment sold at rupees 24,000 rather than it has been the cost of rupees 30,000. So that there will be my 6,000 loss. That's a different thing. But the thing is that there is a bank account debited with 24,000. That means there is a cash inflow in my company. So bank balance is 44,000 after subtraction of the amount reserved. There is the after subtraction of the mandate balance requirement of 26,000 plus investment sold, that is 24,000. So that how much bank balance we are available? 44,000 plus 24,000, that is 68,000. So the first is the five. So the first working note, total amount of premium as well as the total amount of face value. So face value plus premium, that is the total amount of redemption. This is the working note number 1. Working note number 2, how much bank balance are available? That is the 70,000. It has already given in the balance sheet. 26,000 is the mandate amount. So the 70 minus 26, it will be 44,000. And that after selling of the investment, 24,000 is the cash inflow. That is the liquidity. That is 24 plus 44 equal to rupees 68,000. So that this is the bank balance available. Now you see the note number 3, that is in right hand side. Now you can see the right hand side. That is how much number of share issued. So the total amount of redemption is how much? 1,43,000. Less bank balance available, how much? 68,000. So that if you subtract 68,000 from 1,43,000, it will be 75,000. So that the amount of share, now you can remember the question. The fresh issue proceedings, face value rupees 10 at the rate of 10% premium. I repeat this one. That is the, if you remember the question, that is for the purpose of redemption, the company must have to fresh issue. And the fresh issue of rupees 10, that is the face value of rupees 10 at the rate of the 10% premium. So the face value is 10, 10% premium is, that is the rupee 1. So 10 plus 1, that is 11. So that how much amount you must have to require? 75,000. How the 75,000? Total amount of redemption minus bank balance available, that is my amount of requirement, 75,000 divided by the new issue of share, that is rupees 11. So the total, the rounded off figure is 6818. I repeat this once again. Number of share issued, that is my working note number 3. Total amount of redemption is 1,43,000. How this 1,43,000? 1300 preference share into rupees 100. That is the face value is 1,30,000. Premium on redemption, that is 10%. That is 1,30,000 into 10%. That is 13,000. So that 1,30,000 plus 13,000 equal to 1,43,000. Less bank balance available. that you can see in my working note number 2, that is the bank balance available is 68,000. So that 1,43,000 minus 68,000, that is 75,000. So that this 75,000, that is the amount requirement for the redemption. Now, so for this amount requirement, you need to issue fresh issue of share. What is the face value? Face value is 10, premium is 1, that is the new issue price of the share is 11. So the 75,000 divided by 11, that is the rounded off figure, it is 6818 shares. And now you can see how much amount transferred to the capital reserve. This is working note number 4 in the below mentioned or the footnote. That is how much amount transferred to capital reserve. So the face value of share redeem is how much? Just consider the previous sum. Just consider the previous sum. Face value of the share redeemed less number of share issued or the new share issued. Whatever be the residual figure, this residual amount transferred to the capital redemption reserve. I repeat this once again. Just consider the previous sum. Just consider the previous sum. Face value of share redeemed minus proceeds from new issue or the new share issued. Then what will be the residual amount? This residual amount transferred to the capital redemption reserve, that is CRR. So that in that case also, face value of share redeem is how much? 1,30,000. New share issued is how much? 68,180. How this amount? You can see the my working note number 3, number of share issued 6818. So 6818 into rupees 10 is how much? 6810. Then 1,30,000 minus 68,180, it will be 61,820. Now your question may be, sir, if you are talking about new share or that if you are talking of fresh issue, then it must be a premium, that is rupees 11. Yes, you are absolutely correct. You are absolutely correct. But this premium must be utilized if your premium value of redemption. I am just concerning with the capital redemption reserve. Your question is, sir, face value of share is 10. Premium is rupees 1. That is the proceedings from face issue of rupees 11 per share. But you have mentioned new share issued, that is rupees 10. That is 6818 into 10. So in this case, this premium value you can utilize when you are supposed to transfer the premium on preference shares. So that working note number 1, working note number 2, working note number 3 is my right hand side, and the working note number 4, that is the amount transferred to CRR. So that this is the working note. Now we will move to the journal entries, right? So you just see the journal entries. Preference share capital account debit. This is the due entry. Preference share capital account debit is 1,30,000. Premium on preference share capital account debit is 13,000. That is 1,30,000 into 10% of the premium value. To preference share holders account is 1,43,000. So that this is the due entry. Preference share capital account debit. Premium on preference share capital account debit to preference share holders account. Second is the payment entry. That is preference share holders account debit to bank account. Preference share holders account debit to bank account. That is preference share holders account debit is 1,43,000. To bank account, it is also rupees 1,43,000. Now the journal entry number 3, fresh issue of share. Now your question may be, bank account debit 75,000. Why 75,000? Because you have issued 6818. You must have to remember, that is you have issued only 6818. So 6818 into rupees 11, there is some fraction, that is rupees 40, there is some fraction. So that I need to have the exhaustive figure, that is a rounded up figure. So 6818 into rupees 11, that is 75,000, that is the nearest rounded of rupees. To share capital account 6818 into rupees 10. To securities premium 6818 into rupees 1. And the 6818 into rupees 10 and 6818 into rupees 1. And then I am just considering the next rounding of rupee. So the first is the due entry, second is the payment entry, third is the new issue entry or the proceed from new issue. Now fourth, investment sold. That is investment sold at a loss. That is bank account debit 24,000, because you know very well that is the non-current investment is rupees 30,000. So this non-current investment sold at rupees 24,000. So obviously, if I supposed to sell anything, either there will be profit, either there will be loss, or that either there will be the break even. Break even means that is the entire sale is entire cost will be same. So that means that the bank account debit is 24,000. That is the money inflow. Profit and loss account debit is rupees 6,000, and to investment account is rupees 30,000. Okay, there is a printing mistake in journal entry number 4. In journal entry number 4, that is profit and loss account is mentioned 60,000, but the is a 6,000. Sorry for that. Actually, there is a printing mistake that is in journal entry number 4. Now it has been rectified. That is the bank account debit is 24,000, profit and loss account debit is 6,000, to investment account is rupees 30,000. Now in journal entry number 5, that is securities premium. That means premium on redemption. How much premium? 13,000. That is premium on preferential capital account is 13,000. So you must have to fetch this premium value from your free reserve. That is securities premium account debited with 6820. Statement of profit and loss account debited with 6180. That is the next chronological order. That is the next chronological order. 6180, because if you remember the sum only consists free reserve, that is profit and loss account of rupees 90,000. Can you remember? Can you remember, my dear students? So that the only profit and loss account is mentioned in securities premium. So my dear students, the only profit and loss account is mentioned under the free reserve, that is rupees 90,000. So that out of 90,000, for the purpose of payment of preferential capital, securities premium must be fetched from the profit and loss account, that is 6180. So the securities premium account debit 6820, statement of profit and loss account debit 6180, to premium on pref share capital account is rupees 13,000. And the sixth entry, that is the capital redemption reserve, that we have already mentioned in our previous slide. I just need to show it. That is one second. Yes, that is the capital redemption reserve, that is 61,820. So this 61,820, I need to face this amount from the statement of profit and loss account. So the statement of profit and loss account debit to capital redemption reserve account, 61,820. So that this is the main or synopsis of the sum of the redemption of pref shares. So if you classify these 5 categories of sum, so that means understanding or managing this redemption of pref shares will ultimately help the company to managing the liquidity, to managing the shareholder expectation, and to comply with the various type of the regulatory requirements. So my dear students, you must appreciate it is a strategic tool, it is a compliance, it is the optimization of the capital, it is the optimization of the capital management as well as the capital structure. So that the whether the company must have the sufficient amount of fund, whether the company must have the sufficient amount of profit, whether the company must have the sufficient amount of free reserve, whether the company must have the sufficient amount of liquidity, that is the accumulated reserve, whatever it may be. So first and foremost, when I am talking about the redemption, first and foremost, when I am talking about the repurchasing, first and foremost, when I am talking about the buyback, either it will be out of profit or it will be out of the fresh issue of shares. So this is the entire thing from my end. Over to you, sir.
Thank you so much, sir. Hello.
Yes, sir. Yes.
Thank you so much, sir. It was really insightful and detailed discussion on redemption of preference share. I hope students will easily understand the detailed concept from the illustrations and your lecture. And thank you once again, sir, for bearing time for students and KBSAA out of your busy schedule. Thank you so
Thank
much,
you,
sir.
sir. Thank you, sir. Thank you. Thank you.
So we are closing today's session. Okay, sir.
Okay, sir. Okay. Thank you,
Okay.
sir. Thank you. Thank you.
Thank you so much.